Hello, welcome to All About Stocks. My name's Alan. Let's talk about the sentiment about stock market. So, a lot of people don't trust the stock market. They don't want to invest. They don't believe they should invest. They don't think they need to invest. I want to put that myth aside. You need to invest. You should be investing. It's very important to invest. It's critical for you to. So let's look at just a fast Google search. I just put "don't trust the stock market" in Google, and just right off the bat, it said "don't trust the stock market, positive moves." And let's see here. Friday's short list was an excellent test. Okay, well, that's about. Let's look at something else. Let's about the stock market. So let's look for something else. Why you shouldn't trust the stock market. While investing in the stock market carries greater risks, the possibility of you losing all the money you have invested, and volatility, the value of your money has invested going up and down, it could have boosted your returns. A lot of investors or people who are thinking about investing may read this and they may see it as, hey, I could lose all my money. Or people who are investing may see that as, hey, the money I put in may double, triple, or just go up in value. Now, let's look at something else. Where should I invest if I don't trust the stock market? Well, you can invest in real estate, peer-to-peer lending. Well, let's say if you are investing in the stock market, you should definitely invest in real estate also. That'd be like buying a house. Peer-to-peer lending, that's like lending your friend some money, and well, that's kind of iffy if they're going to pay you back. I don't know if I would lend my friend or family money at. So that's up to you. Savings bonds, that's up to you. I think that's part of the stock market, though. Um, you know, I don't know if bonds are stock market. I don't know if that's included, but gold, you can buy gold in the stock market. CDs, uh, corporate bonds. So if you believe in corporate bonds, then you believe in a company. A company, then you should be able to buy stocks. But that's up to you. This is my personal opinion, so take it for what it is. Commodities futures, that's like oil, gold, silver, vacation rentals. I have no clue what that is, so I can't even tell you. I'm just going to go back because I'm not going to read all this. So let's, is the stock market rigged? Are the stock market rigged? Are the stock markets rigged? That doesn't seem like that's correct. So investors rightfully wonder whether the stock markets, the stock market is rigged. That just sounds so incorrectly wrote. Technically, the answer is, of course, no. The stock market is not rigged, but there are some real disadvantages that you will need to overcome to be successfully small investors. That paragraph just horribly. I'm sorry, I'm not a grammar freak or anything, but that's just horrible. Anyways, yes, that is correct. If you are a small investor, you are against hedge funds and corporations. You will have to learn how to be a good investor. This would be mutual funds, holding your position, like buying a stock, holding it for a long time, ETFs, and that's really it. If you just do those main things, then you will be successful in the long run. Day traders are mainly the ones who lose a lot of money. I am not saying that if you buy one stock and hold it for a long time, then you will not lose money. Because there are the specific event or specific instances where a stock will go up in value and then it will lose money. There are, let's say AMC was up significantly and then, well, COVID hit and then it went down. But just like AMC, if you held on to AMC, it did go up. It's just if you sell when it's low, you're going to lose money. Just hold on, and eventually it goes up. Just hold on to your position. Don't sell when you're losing money. Now, I understand that it is tempting to sell when you are losing money, and you don't want to lose all your money, but you have to tough it out, take the pain, if you will, and just keep on holding, and eventually, hopefully, your stock, your position will continue to go up. Now, I'm going to step away from this, and I'm going to hopefully spell this right, and compound interest. Now, the reason that it's so important to start investing as early as possible. If you can start investing, let's say 18 years old, and you, as soon as you get out of high school, or if you are in high school, your very first job, and you get in with Robinhood, Webull, or some company, and you get your first job and you start stacking away $25 into a mutual fund or an ETF, and you just go, hey, I'm going to just put 10% or 5% of each paycheck away into a mutual fund, or just into, I'm going to pay myself, basically, then you are going to start building compound interest. Now, this is why it's so important, is because compound interest will build up. Now, I'm going to show this. Is compound interest is calculated by multiplying the initial loan, which in this case, you are not having a loan. You are paying yourself. So you will be making money on your money, so it would be the principal, by 1 plus the amount of interest. So you will be making money on your own money. So you will be making the interest rate raised by the number of compound periods. So basically, for each month, each year, then you will be making money upon, so to explain it correctly, each time you pay yourself, for each week that you pay yourself, you put money aside, then that money will compound and you will continuously pay yourself. So let me try to show you and I'm trying to make it as easy as I can, but I think I'm making it a little bit more confusing. So let's say you started out with $1, and the mutual fund had went up by 10 cents, and it also had a dividend of 10 cents. So next month, and for this example, we're only going for 3 months. So in 1 month it went up by 10 cents, and on the third month you got a 10-cent dividend. So on first month it went up by 10 cents, and you paid yourself a dividend, or let's do it this way. Okay. So on month 1 you have $1, and you paid yourself $1, and then next month it goes up to $1.10. Then it goes up to $1.20. Now you also get the dividend, but let's say it goes down to $1.10, but it also pays the dividend. So it's going to stay at $1.20. And I'm going to show this as, this is the starting one. This is it going up. This is it going up. This one went down. This is the dividend. And now at the same time, you're going to add $1 on all these. So on all these you add $1. So now you're going to have, on all these stocks, or on all this mutual fund, just for easy figuring, you're going to have, this would be your first one. So now you're going to have the 210, now you're going to have 320, now you're going to get 420, and it's just going to build really fast. Now, this was just an oversimplified version of it. And I know you're saying, well, yes, you're adding $1. It's not going anywhere. But if you compound this over, let's say you started at 18, but if you compound this over 60 years, or let's say 45 years, then you're going to make large amount of money, something in the neighborhood of, if you started at 18, you'd probably be at around 3.2 million, maybe even more, depending on, you know, how your mutual funds or ETFs did, if you were in dividend stocks, and how you diversified. Now, it all just depends. once again, how much you were, putting in, and if you're putting in 10%, 20%, and, so forth. So, I'm trying to make it very simplistic, but see, this is the formula, so it's not as easy as just going, hey, this is 1, 2, 3. So I'm trying to make it slow and easy for you. But the reason you want to start as early as possible is because you want to be able to retire. And once, if you start later in life, like let's say 45, 50, and then you're expecting to retire, let's say at 65, well, you only have from 50 to 65, you only have 15 years to try to get that compound interest to get you up to retirement. Well, then you have to put, let's say, 40% of your paycheck into your, let's say, 401k or other forms of set aside, let's say Robinhood or whatever. Now, that leaves very little for you to work with. Now, what you want to be able to do is set aside enough money for you to live off of once you retire. Now, the key thing is if you're living off of, let's say, $2,000 a month, then the estimation is that you want 10 times that once you retire. And I'm just going off what, of course, Google is saying, or what you can find online. I'm not a financial advisor. I'm just going by what I can find online. If you really want to lock in these numbers, you really want to get if you're really wanting to lock in these numbers, and I'll try to make the screen bigger for you. If you're wanting to lock in these numbers and actually know what you're needing for retirement, then you need to talk to a financial advisor. Talk to someone at Wells Fargo, Fidelity, JP Morgan, and they can give you better quotes and help you get on track for retirement. Now, I'm just trying to give you, a guide. I just want to help you, with, understanding that the stock market's, it might seem scary, but once you actually start investing, it's fun. I'm enjoying it. I love the stock market. I have a lot of fun. But the goal of my channel is just to show you different stocks. And I'm just there to, show you, different sides, or kind of keep you up to date with the news, different stocks, and kind of have fun with it. So hopefully you're enjoying my channel. Hopefully you like, subscribe, and if you see something you like, leave a comment and interact. I'll interact with you. But if you see something different, let me know. But definitely, please start investing as early as possible, because the longer you wait, it's only costing you money. Well, that's all I got for you. So please, like I said, leave a like. Please subscribe. And have a great day. Thank you. Hopefully you learned something new. That's all I got for you.